What if the difference between staying broke and building real wealth has nothing to do with luck, timing, or even income, and everything to do with a short list of decisions almost nobody talks about at the dinner table? Economists have studied millionaires for decades, and one pattern keeps showing up. The people who end up wealthy rarely stumble into it. They repeat a small set of financial habits so consistently that the results become almost mathematical. Today, we're breaking down the money decisions that quietly separate people who build lasting wealth from people who simply earn a good paycheck and never get ahead. Let's start with the habit almost everyone underestimates: protecting your downside before chasing your upside. Behavioral economists call this loss aversion, the idea that losing money hurts roughly twice as much as gaining the same amount feels good. Yet most people build their entire financial life backwards. They chase the next investment, the next side hustle, the next opportunity, while leaving themselves completely exposed to a single bad month, a burst pipe, a medical bill, a layoff. Without a buffer, that one event can force you into decisions you'll regret for years, like liquidating investments at the worst possible time or sliding into high-interest debt. The households that weather financial storms aren't necessarily the ones who earn the most. They're the ones who built a moat around their income long before the storm arrived. But here's what most people miss about growing wealth. Your ability to increase what you earn matters more than almost any investment you'll ever make in your 20s and 30s. A stock market return of 8 or 9% sounds impressive until you realize it takes a large pile of money for that percentage to translate into real dollars. Meanwhile, a single skill upgrade, a well-timed job change, or a new certification can permanently shift your income for the rest of your career. Studies on wage growth consistently show that employees who move between companies capture larger raises than those who wait patiently for annual reviews. This isn't about disloyalty. It's about recognizing that your career is an asset you're allowed to actively manage instead of passively hoping someone else manages it for you. The surprising part is that most people treat spending less as a consolation prize instead of a genuine strategy. There's a reason family offices, endowments, and multi-generational wealth holders spend as much energy protecting money as they do growing it. A dollar you don't spend today doesn't just sit there. It removes the need to earn, invest, and pay taxes on a replacement dollar tomorrow. That's a guaranteed return no market can promise. The families who quietly compound wealth over decades aren't always the highest earners in the room. They're often the ones who understood that keeping money is its own skill, separate from making it. But this changes everything once you understand the difference between owning something and simply using it. Two people can drive the exact same car, live in the exact same neighborhood, and work the exact same number of hours, yet end up in completely different financial positions 20 years later, because one of them owned assets that paid them while the other only owned things that cost them. A rental unit collects rent whether you're awake or asleep. A share of a profitable company sends you a piece of its earnings every quarter. A depreciating car, on the other hand, only ever takes. The wealthiest households in America hold a disproportionate share of their net worth in business ownership and equity. Not paychecks, not cash, sitting idle, not luxury purchases. That single distinction, productive ownership versus simple consumption, explains more about generational wealth gaps than almost any other factor economists have measured. And once ownership becomes part of your mindset, negotiation stops feeling optional. Most people will spend hours negotiating a raise but accept the sticker price on a car, a home renovation, or a service contract without a single question. Yet mathematically, a dollar saved through negotiation behaves exactly like a dollar earned, except it usually arrives without being taxed first. The people who build wealth treat almost every large purchase as a conversation, not a transaction, because they understand that prices are often opening offers, dressed up as final answers. None of these habits are complicated, and that's exactly the point. Wealth rarely comes from one brilliant move. It comes from a handful of unremarkable decisions, repeated so consistently that time eventually turns them into something extraordinary.